Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent, and today we're going to be talking about the ex-dividend dates and the dividend payments. This can be a confusing topic for brand new investors, so I think we're going to try and break it down as easy as we can, and if anybody has any questions, go ahead and leave them in the comments. So if you're a brand new investor interested in investing in dividend stocks, or you hold dividend stocks in your portfolio, we're going to be talking about how the dividend payment is removed from the stock on the ex-dividend date. So in our example, we're going to be using dividend.com, and we're going to be using the ticker symbol T for AT&T. So if you look up T on the dividend.com website, the main thing we want to take a look at is how much do they pay out per year. AT&T pays out $2 per year, and they pay out quarterly. So if we divide 2 by 4, that's 50 cents. And we can take a look down here towards the bottom underneath dividend history that they do in fact pay out 50 cents per share. Their ex-dividend date was on the 9th of January, which would be on Tuesday, and you would get paid out on the 1st of February. So if you bought this stock, remember you must buy the stock prior to the ex-dividend date when it's holding the dividend to be eligible for the dividend payout on the 1st of February. So you bought the stock on the 8th of January, you held it until the 9th of January. On the 9th of on the 8th of January, when you bought the stock with the dividend. On the ex-dividend date, the dividend payment itself is removed from the stock prior to pre-market hours. So then it is trading without the dividend on the ex-dividend date. And we can take a look. We're going to take a look at the example of this. So here is the ex-dividend date was the 9th. So if we go over to Google now and hit T-stock in here, we can see here at the end of the day on the 8th at 4 o'clock, the stock was trading at $38.24. So we punch in $38.24. We subtract, and pre-market hours, or opening hours on the 9th was at $37.63. So $37.63. Now that's a difference of 61 cents. So from the end of market hours on the 8th until the open hours on the 9th, they dropped down by 61 cents. But their dividend payment was 50 cents. What happened? That's because prior, there's always the after hours. So during the after hours, there's still trading volume that's being traded, and the stock can continue to move either up or down in the after hours. So an example of this, or just kind of taking a look at the trading volume, I have my Market Pro here. So here we can see again that it was right around this this range of $38.23 at 4 o'clock, at 1 o'clock Pacific time, which is where I'm at. And then when it opened up down in the $37 range. But down here at the bottom, you can see the trade volume, and the red indicates that there was a massive sell. So we could see that the trading volume was very high. It was much higher than normal, where the trading volume may break around 100,000 shares traded. Instead, this was shares traded in the 5, 6, 7,000 range. So 700,000 shares were being traded, and it was being traded in the negative amount here. So you can see that even after the market opened and the stock, it continued to fall even after the dividend was removed from the stock. It continued to fall just a bit further. Now, if you had put in a limit buy, so sometimes investors can buy after the ex-dividend date, or they want to buy on the ex-dividend date because the dividend's already been removed from the stock. The stock is going to fall by however much they pay out to their shareholders. So this can be a great way to buy a dividend stock without the dividend on a dip. So what these investors may do is, in the after-hour market trading, they can calculate, okay, AT&T is going to drop by at least 50 cents because that's the dividend payments that's going to be paid out to their shareholders. I'm going to add an additional 0.5% off of that, and I'm going to put in a limit buy at $37.50. So after hours initiated, pre-market hours initiated, and then the open hours opened up, and then the stock fell all the way down to $37.50. They would have bought in at $37.50 without the dividend included in that stock price, and then they would have got the capital appreciation, and then they can kind of continue holding on until the next ex-dividend date and have been in it the entire time earning capital appreciation, and then would have received the next dividend payment, not the current one. For you to have received the current one, you would have need to have bought on the 8th and then held into the 9th. So the main thing I wanted to discuss in today's video was that you know, if you're buying for the dividend payout, just know that the stock will fall by however much the stock is paying out to their shareholders. So if they're paying out 50 cents per share, that stock is going to fall prior to the pre-market hours on the next day by however amount they're paying out. Now that you know this information, you guys can take a look at other stocks, try and predict, take a look at what their current stock price is near the end of the day, what their annualized payout, take that quarterly, take a look at how much they pay out per share to their shareholders. You can kind of calculate where the stock price will end up opening on the following day, and if you'd like, you can try and put in a limit buy or limit sell to kind of average down in the stock. If you're trying to buy in for the long term, you can also average down on ex-dividend dates, because then you're buying that stock again without the dividend included in that share price. So ex-dividend dates are great times to buy for long-term investors. If you're interested in buying the stock for the long term, ex-dividend dates are great for buying on the ex-dividend date, just because you're getting sort of a discount. You're not buying it with the dividend, but at the same time, you're not going to get that dividend payout. But you can kind of predict, okay, the stock is going to go down by 50 cents. I'm going to add another 10 cents on top of that. I'm going to predict that the stock's going to go down 60 cents by pre-market hours the next day. So I'm going to put in my limit buy at a difference of 60 cents. And if you are able to buy at a buy-in price of 60-cent difference for the able to average down, now you just saved a little bit of money. The stock, as long as you're in it for the long term and you believe it'll rebound, you'll get those capital gains and you'll get those extra shares without the dividend included in that stock price. So that is it for this video. If you guys have found it entertaining and fun, if you learned something new, go ahead and hit the like button below. Comment if you've learned something. If anything needs to be made more sense, go ahead and let me know. I can try and break it down a little bit better. I want to thank everyone for watching up until this point. If you did like the video, again, hit the like button below. Please remember to subscribe to my channel. I do make all sorts of financial videos on the stock market, investments, and such. And if you are a reoccurring viewer or a brand new viewer, subscribe to my channel. It really helps me out. It's 100% free. And if you have any questions, leave them below. Or just want to say hello. Thank you guys for tuning in. I will see you guys next time. Have a great day. Bye-bye.